After the abrupt expulsion of Chinese corporate executives from Niger and the seizure of Chinese-operated refineries and hotels, the country was quickly plunged into a fuel crisis. Just 1 week after Chinese technicians left, the price of diesel in Niger surged by over 300%, creating economic chaos and public outcry. Now, Niger is seeking to reopen negotiations with China, but the question remains, why did the government take such a drastic step? And can the relationship be repaired? Niger is a landlocked country in West Africa, spanning more than 1.26 million square kilometers, making it the largest among West Africa's landlocked nations. Despite this vast territory, Niger's population is only about 27 million. Its economy has long struggled, and in 2023, the country's GDP per capita was just $642. An extremely low figure by global standards, placing it among the world's least developed countries according to the United Nations. Yet, Niger is rich in natural resources, particularly in uranium and oil. The country holds the fourth largest uranium reserves globally, with approximately 420,000 tons confirmed and an annual output of about 3,000 tons. Oil reserves are equally notable, estimated at around 499 million tons. These resources, in theory, could have supported Niger's economic development and helped lift millions out of poverty. However, due to a lack of advanced technology, skilled labor, and necessary infrastructure, these natural riches have not been effectively developed. Agriculture remains the primary economic activity, though it is limited by Niger's arid climate and poor soil conditions. Most of the country is covered in desert, and only drought-resistant crops can grow, often with poor yields. As a result, much of Niger's food has to be imported, adding pressure to its fragile economy. Livestock farming is more robust, with an estimated 30 million head of livestock, and plays an important role in the agricultural sector. But despite its significance, animal husbandry has not been able to meaningfully improve the quality of life for most Nigerians. Faced with these challenges, the Nigerian government began seeking international support, hoping to attract foreign investment and assistance to drive development. But many Western countries offered help only in exchange for military or political concessions, including the establishment of military bases. This left Niger in an awkward position. In contrast, China emerged as a partner willing to offer economic aid and infrastructure development without such controversial conditions. China's involvement in Niger began as early as 2004. That year, Beijing donated 290 tons of agricultural fertilizers to help improve food production and contributed 11,000 water pumps and spare parts to upgrade irrigation systems. China's support extended far beyond agriculture. It funded and constructed essential infrastructure, including bridges and roads. A standout project was the General Sani Kuncha Bridge in Niamey, which connects the densely populated Gal district in the west with the Lamord transportation hub. Completed in 2021 after 3 years of construction, the bridge dramatically improved connectivity. But the most transformative aspect of China's presence in Niger has been in the oil sector. While some Western oil companies began exploration in Niger as early as 2003, most withdrew due to high risks and low returns. Chinese companies, however, stepped in and signed a 22-year integrated development agreement with the Nigerian government. This included upstream and downstream operations, from exploration and extraction to refining and transport. Over the next 2 decades, China invested more than $5 billion in Niger's oil industry. Major projects included the development of the Agadem and Bilma oil fields, the construction of a crude oil pipeline stretching 462 kilometers across the desert, and the establishment of the Zinder refinery, capable of processing 20,000 barrels of crude oil per day. These initiatives fundamentally reshaped Niger's energy sector. For the first time, Niger was able to meet its domestic fuel needs and even begin exporting oil. The price of gasoline, which once exceeded $2.50 per liter, dropped to around $1, making fuel far more affordable for everyday citizens and businesses. By the end of 2023, the oil industry accounted for roughly 10% of Niger's GDP, 12.5% of government tax revenues, and created over 4,000 local jobs. The economic benefits were not confined to industry alone. Chinese investment also helped fund healthcare and education initiatives, bringing tangible improvements to local communities. With proven reserves growing to over 6 billion barrels by 2025, Niger stood to gain hundreds of billions of dollars in future revenues, potentially transforming its economy. However, in early 2025, this partnership suffered a dramatic collapse. The Nigerian government accused Chinese companies of paying disproportionately high salaries to foreign managers, 3 to 4 times more than local staff, and failing to employ a sufficient number of local subcontractors. Yet, these criticisms overlooked the realities on the ground. Chinese employees were working in grueling conditions, with surface temperatures often exceeding 50 degrees Celsius, limited health care, rampant diseases like malaria and meningitis, and virtually no supporting infrastructure. These professionals brought with them not only technical skills, but also global experience and project management capabilities that local workers, through no fault of their own, often lacked due to insufficient vocational training and limited educational opportunities. But there was more at play than salary grievances. Niger was facing a severe fiscal crisis. Foreign exchange reserves had dropped to critically low levels, barely enough to sustain 2 to 3 months of imports. In 2024, Niger had borrowed $400 million from Chinese oil firms to ease its financial pressures. When the repayment deadline approached in 2025, the government began stalling. Negotiations were initiated to alter the original agreement, with Niger requesting an increase in its share of oil profits from 15% to 30%, a proposal far outside international norm. When Chinese companies rejected these terms, the Nigerian military-led government escalated matters by demanding more than $1.1 billion in alleged unpaid taxes and issuing new loan demands. Chinese executives, recognizing the risk of setting a dangerous precedent, refused to comply. This standoff embarrassed the military leadership, prompting them to take even more extreme measures, including the expulsion of senior Chinese personnel and the freezing of corporate assets. Backed by a new sense of confidence, possibly bolstered by security arrangements with Russian private military groups like Wagner, the Nigerian government assumed China would make concessions to protect its substantial investments. But China acted quickly and firmly. It suspended work on the Niger-Benin oil pipeline, a $4 billion project that was poised to become the largest infrastructure development in Niger since its independence in 1960. Chinese technicians were withdrawn from key sites, including the Zinda refinery, effectively halting oil production. China then launched formal arbitration proceedings under international investment agreements and sought support from organizations such as the African Union to apply diplomatic pressure. The impact on Niger was immediate and devastating. Without Chinese expertise, oil output fell by 70%, triggering a national fuel shortage. Gasoline stations across the country ran dry. On the black market, prices soared as high as $2.40 per liter, a four-fold increase from prior levels. For ordinary citizens in a country where the average annual income is just $642, fuel became completely unaffordable. Power outages spread rapidly. Roughly 80% of the national electricity supply was disrupted. Streets in the capital, Niamey, fell dark at night. Shops closed early. Factories suspended operations. Cooking and basic household tasks became difficult or impossible. In desperation, the government borrowed 300 tanker trucks of gasoline from neighboring Nigeria, but it was far from enough to meet demand. The situation sparked widespread protests. Unemployed workers and ordinary citizens took to the streets demanding answers. The military government, already facing mounting fiscal deficits, had to pour money into domestic security and emergency subsidies, further straining its collapsing budget. Now, with its back against the wall, Niger is seeking renewed talks with China. Officials are hoping Beijing will agree to resume cooperation and restore oil production. But China, having already suffered significant financial losses, is understandably cautious. Over the past decade, China has gained a strong reputation across Africa as a development partner, one that builds roads, hospitals, power plants, and refineries, and does so with fewer political conditions than the West. Niger's actions stand out as an exception rather than the norm. Whether China will reinvest in Niger remains to be seen. While the market is attractive and the sunk costs are substantial, future cooperation likely hinges on Niger's willingness to resolve disputes, respect past agreements, and restore trust. For now, the country faces an uncertain future, and its government is learning the hard way that alienating a major development partner comes with steep consequences.